studying your last two. I swim with tea when they turned in. The staring down to mute and can learn the pole that sunk he died.
In the previous section, we learned how Option 1 allows a corporation to report known investment income and estimate the remaining income when the final T3 information is not yet available. But what happens next? What happens when the actual T3 finally arrives? This is where many students assume the process ends. In reality, the process is only entering its next stage. Let's go back to year 1. The corporation had a non-calendar year end. The final T3 information was not available. So the accountant used a reasonable estimate, prepared the tax return, and filed the T2 on time. At that point, the return was completed using the best information available. Several months later, however, something important happens. The actual T3 slip arrives. For the first time, the accountant can see the real allocation of investment income, the actual amounts of interest income, dividend income, capital gains, foreign income, and any other components are now known. This creates a new opportunity. The accountant can compare the estimate used in year 1 with the actual information reported on the T3. Naturally, many people assume the next step is simply to enter the T3 into the books. But that is not how the process works. Remember, part of the income on the T3 may already have been estimated and reported in the previous year. If the entire T3 were entered without adjustment, some income could be reported twice. The arrival of the T3 therefore creates a reconciliation process rather than a simple data entry process. The accountant must determine which amounts were previously estimated, which amounts belong to the current taxation year, and how the actual information compares to the estimate that was originally used. This is why year 2 is so important. Year 2 is where the estimate begins to connect with reality. The estimate from year 1 is no longer just a prediction. It can now be evaluated against the actual T3 information. And that comparison becomes the foundation for future reporting. The most important takeaway from this slide is that the arrival of the T3 does not end Option 1. Instead, it begins the reconciliation process that allows the accountant to refine prior estimates and prepare for the next reporting cycle. In other words, year 1 was about estimating. Year 2 is about reconciling, learning from the actual results, and continuing the methodology into future years. Now let's examine the most important concept in the year 2 methodology. Once the actual T3 arrives, how do we calculate the investment income that belongs in the current taxation year? The answer is a 3-step process. First, start with the actual income reported on the T3. Second, remove the portion that was already estimated and reported in the previous year. Third, add a new estimate for the current year that is not yet reflected on the T3. This leads us to the core year 2 formula. Actual T3 income minus the prior year's estimate plus the current year's estimate equals the investment income that should be reported for the current taxation year. Let's walk through why this works. Imagine a corporation with a February 28th year end. The T3 that arrives covers the calendar year from January 1st to December 31st. However, the corporation's taxation year does not follow that same period. Part of the T3 relates to months that were already reported in the previous taxation year. For example, January and February of the prior calendar year may already have been included through last year's estimate. If we leave those amounts in the calculation, we risk reporting the same income twice. That is why the first adjustment is to remove the portion that was already reported. Think of this as cleaning up last year's estimate and replacing it with actual information. Next, we keep the portion of the T3 that truly belongs to the current taxation year. In many cases, This is the March through December period shown on the T3. This income belongs in the current year and remains part of the calculation. However, another problem immediately appears. The T3 only goes to December 31st. The corporation's taxation year continues beyond that date. For a February 28th year-end, January and February of the new year are still missing. Those months are not yet reflected on the T3 because the next T3 has not been issued. So once again, an estimate becomes necessary. We add a new estimate for the months that are not yet available. This is why the process repeats every year. One estimate is removed, a new estimate is added, and the cycle continues. Visually, you can think of the T3 as a timeline. The beginning of the timeline contains income that may already have been reported. The middle portion belongs to the current year, and the final months of the corporation's taxation year still require estimation. The Year 2 formula simply adjusts each of those pieces so that the correct income ends up in the correct taxation year. The key takeaway from this slide is simple. Actual income replaces last year's estimate, but a new estimate must be created for the current year. And that is why the formula becomes actual T3 income minus the old estimate plus the new estimate. Once you understand that formula, you understand the foundation of the entire Year 2 methodology. At this point, we've learned how Option 1 works in Year 1, and how the Year 2 formula adjusts for prior estimates and new information. Now let's discuss the most important practical implication of this methodology. The estimation cycle never really ends. Many students assume that once the actual T3 arrives and the estimate is reconciled, the problem is solved. Unfortunately, that is not the case. As soon as one estimate is removed, a new estimate must be created, and that process repeats every year. Let's look at the cycle. The year begins with an estimate. The corporation prepares its financial statements and files its T2 return using the best information available at the time. Several months later, the actual T3 arrives. The accountant then compares the estimate to the actual results and performs a reconciliation. Differences are identified and analyzed. Some estimates may have been very accurate. Others may need adjustment. But once that reconciliation is complete, another issue immediately appears. The corporation is now approaching the next year-end. And once again, there will be a period for which the final T3 information is not yet available. That means a new estimate must be created. The cycle begins again. Estimate. File. Receive the T3. Reconcile. Create a new estimate. Repeat. From a technical perspective, this is the greatest strength of Option 1. The methodology attempts to match investment income to the correct fiscal year. Income is reported in the period to which it economically belongs. This generally creates better matching and often produces more accurate fiscal year reporting. However, that same strength is also its biggest weakness. Because the methodology relies on estimates, reconciliations, and ongoing adjustments, it creates continuous administrative work. Every year requires supporting calculations. Every year requires working papers. Every year requires reconciliation procedures. And every year requires documentation that explains how the estimate was determined. For small investment portfolios, this additional effort may be manageable. For larger portfolios with multiple mutual funds and complex investment income streams, the workload can become significant. That is why consistency becomes so important. The objective is not to reinvent the methodology every year. The objective is to apply a reasonable and consistent process that can be repeated efficiently. When done properly, each year's estimate becomes more informed because the accountant learns from prior year results and actual T3 allocations. Over time, the methodology can become increasingly refined. The key takeaway from this slide is simple. Option 1 is not a one-time adjustment. It is an ongoing annual process. Every year removes an old estimate and creates a new one. And understanding that never-ending cycle is essential to understanding both the benefits and the administrative burden of Option 1. This reality is exactly what leads many practitioners to consider the alternative approach that we'll examine next. Option 2, where investment income is reported directly using the T-slips from year to year.